Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thanks very much for listening to this video today. And as usual, guys, don't forget to like this video and subscribe to my channel. I know I say that every week, but it is really important for the YouTube algorithm and to get it out to more people. So take a pause, please like and subscribe to my channel. So in today's video, I'm going to be talking about the main things that happened in the market last week. I'm going to be running over some news, as well as talking a little bit about how our portfolio performed, some charts as usual, and then a little bit about overall strategy as well. So today I'm going to keep my video a little bit shorter than usual because the last couple have gone on for a long time. So as we look at our performance last week, our portfolio was up about 1.64%, which was a good result. Overall, the US indices did really well. So the NASDAQ was up about 4.6% last week, and the S&P was up about 1.9%. And it was a very good week overall for tech and consumer discretionary as well. And it was really good because the S&P 500 officially came out of bear market territory and is down at about minus 18.2% overall for the year so far. And the NASDAQ is down about 25.6%. But it was very good to have a nice relief bounce after which was quite a tough week in the market the week before. So it's nice to have that bounce. Overall, the US markets did pretty well, as well as the European markets to a lesser degree, but still were mainly positive. However, it was a slightly poor week overall for China, and I'll go into the reasons why later, but that did have an effect on our portfolio and meant we slightly underperformed the US indices last week, but we do have a lot of Chinese stocks in our portfolio, as well as European stocks, which underperformed the US. It was also a rebound for oil. So oil went down considerably at the beginning of the week and the end of last week. And we had a nice bounce up in oil right at the end of the week, which took it back over 100, but earlier on the week it fell below 100. If we look at the main news of what happened last week, so I mentioned that the S&P is now out of the bear market territory, and consumer and discretionary tech performed the best out of everything. Oil prices, as I mentioned, they plunged under $100. Before recovering before the end of the week. The main reasons why the US market did pretty well last week is there was a lot better data that was provided from the market. So the non-farm payroll was good. So it showed a very low level of unemployment, which was actually better than some of the consensus estimates that were in place. We also saw a lot higher figures in terms of manufacturing. Hourly wages are going up as well as the number of open jobs. So the employment in the US is still very good, and historically still the unemployment rate is historically still very low in the US. We also saw some optimism around the interest rate hikes. The futures are pricing in a 0.7% rate hike for the next FOMC meeting, Fed meeting. There was further comments by other policymakers in the Fed who said that they continue and their intent is to continue to raise those interest rates as high as possible. However, not many people are pricing in a 1% rate hike. That looks like it's a step too far. But the federal funds rate futures are pricing in that 0.7% rate hike, which should be good in order to keep a lid on inflation. However, we do know that that has some effects, especially on technology stocks and other growth stocks. The European Central Bank minutes of the June meeting showed most members are agreeing to a 0.25% interest rate increase in July, and they tend to be leaning towards a 0.5% or 50 basis point move in September. The European Central Bank, they seem much more keen to very regularly increase the interest rates, but do it in a very slow and moderated fashion, which is why we're seeing just these 25 basis point hikes, but regularly. We also saw some news from the UK, big news. Boris Johnson resigned from his position as the Prime Minister of the UK after 50 different ministers handed in their resignations. And it's kind of been quite a long time coming. There's been a lot of grumblings about the way that Boris Johnson managed the whole COVID-19 situation and many other fumbles that he's had since being the Prime Minister of the UK. He's due to stay on for a while until the Conservatives elect a new leader. However, he's obviously given his intent that he will leave his position. The UK markets didn't seem to suffer too much this news. Maybe they thought it was good news and that Boris Johnson was negatively affecting the economy. However, the Chinese market didn't do so great last week, and a lot of that is to do with the COVID cases have increased. There was optimism the weeks prior that the COVID restrictions were starting to be lifted, and that was last week. There was a lot of data which said that the COVID cases are increasing again slightly in China, which obviously put some fears again that there may be increased COVID measures in the future. We also saw the very sad news of the Japanese ex-Prime Minister who was killed last week in a shooting, which was very tragic news. So, as I move on to the top 3 performing stocks in our portfolio last week, the top performing stock in our portfolio last week was Coinbase, which was up by about 22.94%. Coinbase has been absolutely crushed over the last kind of couple of months. It's very much in line with what's happening, what has happened in the rest of the crypto market. However, we did see a good bounce in cryptocurrency price, especially Bitcoin, last week. So as Coinbase was off quite a low base, it had a nice rise last week. I'm still pretty positive also on the crypto market, which I mentioned. I think that we have either bottomed or we're quite close to bottoming. But I think that, again, a lot of these crypto related equities are also suffering and they have some good upside ahead. Second best performing stock in our portfolio was Corbus Pharmaceuticals, and that was up by 20.33% last week. And another kind of pharmaceutical and bio company at number 3 was Bluebird Bio, and that was up about 16.38%. Again, pharmaceutical companies have been and biotech companies have been pretty hard hit over the last couple of months, and they're off very low valuations. Bluebird Bio had been hit pretty hard. However, over the last couple of weeks, there's been growing optimism that they're going to get FDA approval for their gene therapy, which would be very good news, and actually achieved 2 potential votes last week, and which made a nice rise in the price of Bluebird Bio last week. So I'm going to go over my usual segment called Death by Charts. and this is going to be called the recession edition. And the reason why I call it the recession edition is I just want to outline a few different charts for you. If you look at the chart to the left-hand side, which we've taken from Y charts, you can see all the different areas where there had been bear markets and recessions in the past. And this is the ISM manufacturing and the new orders in inventory. And as you can see, during those bear markets, you can see, and those recessions, you can see that the ISM manufacturing number had reduced quite significantly below that red line in all of the different occasions. At the moment, it is sitting just below that red line, but it's actually holding up a lot better in terms of the number of manufacturing and new orders than we've had in previous recessions. It will be interesting to see over the next couple of months if that does dip much further. But as you can see, the last one in 2020, when we had the COVID outbreak, obviously manufacturing was much more affected, but that was obviously because there was a lot of closing down of factories. If we look at consumer confidence as well, the consumer confidence index to the right-hand side, the top right-hand side, you will see that the consumer confidence index is actually going down slightly. Obviously, this year it has dipped, but it hasn't dipped to those levels that we saw in 2020 or during the Great Recession in 2009. So it's actually holding up a little bit better than most people would expect. Another barometer, though, of the economy is the copper price. And if you look at the copper futures price at the bottom left-hand corner, you will see that the copper price is starting to go down, and it has actually gone down quite significantly over the last couple of weeks or so. And actually now we're at the kind of lowest level that we have been at since 2020, but we're not at the level we were during the very lowest copper price during the COVID-19 first outbreak. So it'll be very interesting to continue to watch that further. I actually think that copper is actually very attractive prices at the moment. And I expect if we do go into recession, I expect it to be shallower than previous recessions that we have had in the past, and it could be shorter. And that's mainly because I think that eventually the Federal Reserve are going to do a U-turn on their interest rate rises. But I do not think that will happen for a good few months until they see very solid results in terms of inflation peaking and starting to trend down slightly. Another chart I wanted to bring up was the bottom right-hand corner chart. And this is the office occupancy rate in the main metropolitan areas in the US. And I thought that this was a really interesting chart for two reasons. One, it obviously shows a little bit more about the economy and whether the economy is, slumping, or whether there's bigger issues in terms of companies hiring, etc. And the other important one, which I wanted to bring up, this really does show a shift from people working from offices to people from working from home. So obviously, if we look at the major cities, so San Francisco, Washington, DC, Los Angeles, even New York is not on that chart, but it's also has a very similar pattern. We have seen that obviously there was a big drop off at the start of 2020 when everyone went into the pandemic and there was lockdowns. So many people were working from home, and then we've seen really kind of a gradual increase really of people working from going to the office and less people working from home. However, it's very likely that those figures will never go back to the way that they were before COVID, because a lot of people have got used to working from home. However, we are starting to see office occupancy rates increase as people are starting to go back into the office. So that's a kind of a good metric really to see future trends of how important the office is going to be in workers' life, but also a little bit of a barometer of the economy as a whole. So now on to the crypto market. The crypto market was quite quiet, if I'm going to be honest with you, last week. Bitcoin had a nice rise. It has risen by about 6.3% and is now over about 20,500 the last time I looked. And what I really wanted to say is the crypto market starting to heal after all of the liquidations and defaults? Obviously, over the last couple of months, and it really started with the UST and the Luna debacle that happened. There were many crypto companies and within the ecosystem that got caught up in that. And we saw kind of liquidations, defaults, and we also saw some lenders that stopped allowing withdrawals. And then we have seen some very large companies such as FTX, Binance are also looking at potential investments in some of these struggling companies as well. So I do have the feeling that things are starting to heal in the ecosystem. Things have gone a little bit quiet, which is generally actually a good sign. And I think the further we come out from that UST Luna issue that we had, and it's clear that there are not going to be more companies that have been caught up in it and that are secretly facing a liquidity crunch, I think that the better off we will be and the closer we will be to a bottom. So I'm still thinking that we're quite close to a bottom, or we have already bottomed. I just want to say that it's quite normal for us in crypto to go through these large drawdowns in terms of the Bitcoin and the crypto price. Just in the 10 or 11 year history of Bitcoin, there have been many 70% drawdowns and even one 90% drawdown, which I think was back in 2013. So it's very common to have these drawdowns. And as we all know, that was kind of kicked off a lot by the liquidity issues in the market and those rising interest rates, which started off and also caused a massive fall in the stock market prices as well. And that has trickled its way through into crypto, because crypto is seen as a risk-on type of asset. And during times like this, many fund managers, for example, they rebalance their portfolio and take away risk. In the same sentiments, we've also seen two 70% drawdowns in the history of Ethereum, and that's only been around since, what, 2016 or so. So really what I wanted to say is, in hindsight, most of these downturns had a pretty obvious root cause. This could have been exchange hacks, bankruptcies, or monetary policy and Fed decisions, which we're seeing at the moment, as well as those defaults. The EU Parliament also agreed to implement a new policy mainly focused around crypto wallets, and this is known as the Transfer Funds Regulations, or TFR for short. I think we're going to see a lot of regulations that are going to be put in place during this bear market. Especially, I think we will see it around stable coins. I think that that's the first thing that many of the regulators want to get a handle of and put in really good regulations around these stable coins to really stop what happened with the UST situation. And I think both the US and the EU will continue to drive through these regulations, which I generally see regulation as a good thing for crypto in the long run, because it sets a framework for people in the crypto ecosystem to work around, rather than trying to walk around in the dark. Okay, so now I'm just going to run through some Bitcoin charts and some on-chain metrics. And as you can see, the chart to the left, and that is the number of active entities over a 30-day moving average. And what this really does is shows the activity and the number of active entities in Bitcoin. And what you will see there is a very obvious number, is you will see in 2021, had the most number of active entities, and that's obviously when the price was at the highest. But the way I like to see what happens in Bitcoin is every cycle you have a lot of new participants that come into the market. They get very excited by high prices, and they dig down the rabbit hole and try to learn as much as they can about crypto, or they learn about Bitcoin. And then many people stay into the bear market. But you also lose a lot of crypto tourists that were in it, simply for the money over a short period of time. So you do see a drop off in the number of active entities. But what I like to see in these charts is I like to see that we continue to reach a higher low. So if you see what's underlined there in green, you can see that it's always made a higher low, a higher low. So the number is continuing to increase. You might see these spikes here and here, but then they come down and they're still higher than the previous lows. And as we see there, it's again higher than the previous low. So this is a good sign, and it does give you a good idea of when you think things might be bottoming. I wanted to talk a little bit now about this chart to the right and talk a bit about minor capitulation. And what I'm talking about is over the last couple of months or so, we've seen still very high levels of hash rate, but we've seen the Bitcoin price continue to plunge down to the levels we are now at 20,500. And what this means is that many miners, they held on to their Bitcoin and they were not selling it at higher prices. And as mining difficulty increased and the prices started to go down, they felt a liquidity crunch, and many of them were forced to sell their Bitcoin in order to survive. And usually the bottom of the market is usually the very last stage of before we bottom. We usually see some selling of Bitcoin miners, and we have continued to see a bit more selling for Bitcoin miners over the last couple of weeks. So I still think that we are very close to the bottom of the market, or we have reached the bottom of the market. I think it's going to take a pretty significant default or a large quantity of Bitcoin sales in order to push the price down one leg lower. However, I do think it's a very good time to be dollar cost averaging into crypto. It's obviously risk attached to that, so it's not financial advice, but I am of the opinion that in the next year to 2 years, this will seem like a really great price point to be dollar cost averaging into Bitcoin, especially because I think Bitcoin tends to bottom first because of the institutional interest, and because it's the #1 crypto by market cap. You tend to see a lot of capital flowing into Bitcoin first. So that's it for today. Thank you very much for listening to my video. Again, don't forget, I say this every week, I do, But please join my Discord group if you haven't already. Amazing community there. And it's a really good way to be able to interact with other copiers and ask me any questions whenever you have them. So have a great week ahead, everybody. Any questions, let me know.